80% returns in just 1 year. That's what the Bandhan Small Cap has delivered, making it the best performing small cap mutual fund in India in the past year. And small caps have been on fire across the board. As you can see, ITI, Invesco and Mahindra Manulife, all their small cap funds have given about 60% returns in the past year. Even India's largest fund, which is Nippon India Small Cap, that manages over 60,000 crores, even that has gained about 50%. And I do understand that when people think about small cap investing, two things usually come to mind: huge returns and huge risks. And it's true, small caps have the potential to deliver explosive gains, but they can also be highly volatile, which can make them a double-edged sword. So the question is, how do you invest in them without getting burned? In today's video, I'll show you both sides of the small cap investing story. How can they generate these incredible returns, but also the risks involved, and more importantly, the right strategies to invest in small cap mutual funds. Hello everyone, I'm Udayan Adhye and I've been licensed in Indian financial services since 2015, first in insurance and then in mutual funds. And so far, I have helped over 1,500 families make better financial decisions. And on my YouTube channel, I talk about all things money and personal development. So first up, what exactly are small cap stocks? According to SEBI, which is India's stock market regulator, the top 100 biggest companies by size in the Indian stock market are called large cap stocks. Then those ranked between 101 and 250 are mid cap stocks. And any stock ranked beyond 250 is considered a small cap stock. Now, small cap mutual funds are mutual funds that invest at least 65% of the money they manage in small cap stocks. Now, that just means that the remaining 35% can be invested in large cap and mid cap stocks, allowing flexibility when it comes to portfolio construction. In fact, let me show you the example of Quant Small Cap Fund, which manages about 25,000 crores and in the past 1 year has delivered over 50% returns. By the way, such returns usually aren't sustainable. They will mean revert, not just for Quant, but for all funds in all categories. Now, the interesting thing that you will see in the Quant Small Cap Fund when we go to its portfolio is that the largest stock allocation that it has is Reliance Industries. So Reliance Industries, which is India's biggest stock, is part of a small cap mutual fund. But despite that, because 65% of the money at least that Quant manages in this small cap fund is in small cap stock, it is categorized as a small cap mutual fund. And when I say small cap stocks, even the 251st largest company in India is worth about 34,000 crores. So relatively, it's still a big number. But obviously, as we go down the list, closer to the 500 stock, the market cap starts to reduce to about 12,000 crores. So now let's dive into the performance of small cap mutual funds. And while the recent 1 year rally has been massively impressive, it's important to zoom out and look at longer term returns. Over the past 10 years, small caps have delivered an annual return of 18.08%. That means 1 lakh invested 10 years ago would have today been worth 5.26 lakhs. That's a growth of over 5 times. And in comparison, large cap stocks grew at an annual rate of 14.45%. So 1 lakh invested in them 10 years ago would have today become 3.85 lakhs. But that is not a fair comparison at all. And because you watch my videos, you know that I don't like to look at absolute returns like this that just consider a single start date and a single end date, because that can be heavily influenced by 1 or 2 really bad or good years. So instead of absolute returns, I prefer looking at rolling returns, which consider the average returns at multiple points in time, giving you a better idea of an investment's consistency. And by doing so, you can avoid the impact caused by one-off events. Now I'll share my screen with you to show you how rolling returns look like for large caps and small caps, so you'll also get a better idea of how they work. So if I let my mouse hover over this one point, you will see that it's calculating returns from 3rd January 2012 to 3rd January 2022. Now, if I just move my mouse by just one factor, you will see now the returns that are being calculated are from 1st Feb 2012 to 1st Feb 2022. So for every point that you see here, as you see the dates change, you will see that it calculates returns 1 month later and it calculates a 10-year period, right? So to get an idea as to how a fund has performed, we want to look at the median returns that have been generated over this entire period. So for an SIP, large caps have generated median annual 10-year rolling returns of 13%, while small caps have offered about 15%. So a 10,000 per month SIP with a 10% annual step up would have grown to over 35 lakhs in large caps compared to about 39.5 lakhs in small caps. But what about risk? Now, small caps are much more volatile. We all are aware of that, but how can we quantify that? That can be done through something called as standard deviation, which you can see on your screen right now. You will see that small cap SIPs have a standard deviation of 4.32 compared to just 2.08 for large caps. So in simple terms, that just means that small caps have larger ups and downs compared to average returns. Here's another very crucial point. If you had invested in large caps for at least 10 years, you would have never had a negative return. However, in small caps, there was a period, if you notice, right at the time of the COVID crash, where you would had negative returns for a very short period of time. Then how would a lump sum or a one-time investment performed? The 10-year median rolling return for large caps is 12.8%, while for small caps, it is, wait for it, 12.9%. Are you surprised? They are very, very similar, right? And once again, small caps have taken much higher risk, which is captured in the standard deviation, which is 4.18 for them compared to 2.51 for large caps. Meaning small caps once again come with far more volatility and risk. And this becomes very, very important to understand because once your money is invested in small caps, it will fluctuate more in value relative to large caps. And the best investors are able to absorb the pressure when it comes to handling such stock market volatility. They know that their money moving up and down in value and at times even dropping by 10% or more is extremely common. Let me just put that in perspective. Now, with small caps, the returns are explosive both on the upside and downside, and that is captured beautifully in this Funds India research. Now, you will notice here small caps are shown in red and you will see how they have performed every calendar year, what has been their biggest fall. And almost every single time, you will see that small caps have fallen more by both mid caps and large caps. So in the first year, once again, the small caps have fallen at the most by -29, whereas mid and small caps are much lower. In 2008, during the global financial crisis, small caps were down -76%. Whereas large caps were down by about -59%. And you will notice this pretty consistently in the past 20 years. In fact, in 19 of the last 20 calendar years, small cap funds have fallen by 10% or more at least once a year. And in the 1 year where they did not fall by 10%, which was in 2017, they fell by 9%. On the other hand, large cap funds have fallen by 10% or more in 13 out of the last 20 years. And while creating a strategy to invest in small cap mutual funds, it is extremely vital to understand this. Let me explain that with a quick example. Imagine you invest 10 lakh rupees and that investment grows by 25% in 1 year. So now you have 12.5 lakh rupees. But then the market drops by 10% and your investment is now worth 11.25 lakhs. Now, even though you're positive, here's the catch psychologically. Losing that 10% feels worse than the joy of gaining 25%. This is a concept called loss aversion, where losses impact us twice as much as gains. So even though you're still ahead, it can still feel like a loss because our mind is fixated on the highest point our investment had reached at. And that is why investing in small caps requires a very strong stomach and a long-term investing approach. When your portfolio drops from its peak, and it's very evident, right, that happens with small cap mutual funds, it's easy to panic and wonder, what if the investment drops by another 20%? Should I sell now and buy back later if the investment is down further? But all these thoughts are driven by fear and not a solid investing strategy. And knowing how wildly small caps can fluctuate in value will prepare you better to ride out the swings. But even then, trust me, the next time your small cap investment drops by 10%, you will still feel that pit in your stomach. And in moments like that, come back to this video and remember how small caps have generated seriously high returns for those who were patient and those who thought long term. So now the big question. What's the right strategy to invest in small cap mutual funds? I'm going to share 3 ideas with you. First up, you can invest in small caps through multi-cap funds. Now, these are mutual funds where the fund manager has to invest at least 25% of the fund's money each in large caps, mid caps and small caps. It's a balanced approach that lets you get exposure to the smallest companies without putting all your eggs in just the small cap category. And by spreading your investment across different size companies, you're getting best of all the worlds. Relative stability from large caps and growth from mid caps and small caps. Now here are India's biggest multi-cap funds. You'll see Nippon India has about 38,000 crores in it, and absolute returns range from about 43% to 55%. And if we dive deeper into the Nippon multi-cap fund, we'll see where it invests money and what is the breakdown across large, mid and small cap. So you'll see that small cap is at about 30% of the fund's money. So let's say you're investing 1 lakh rupees in this mutual fund, then 30,000, that is 30%, will get invested in small caps. And this proportion, by the way, keeps on changing as and when the fund managers feel there's an opportunity in different pockets of the Indian stock market. Now let's quickly look at also how generally multi-cap funds allocate their money across large, mid and small cap stocks. You'll see that the category average is about 31 when it comes to how much multi-cap funds invest in small caps, and this fund is also following a similar strategy. Let's compare the rolling returns for an SIP for small caps and the multi-cap category, and you will once again notice that multi-caps tend to fall lower, especially this was evident during the COVID-19 pandemic crash, where multi-caps over a 10-year period still delivered positive returns of 4.8%, whereas small caps were slightly negative. When it comes to median rolling return performance, small caps actually have generated 15%, whereas multi-caps have generated higher returns at 15.2%, and they have done that, if you notice, while taking on lower risk. So the standard deviation for multi-caps is 2.84 and for small caps it is 4.32. The second strategy to invest in small caps is through a flexi cap mutual fund. Now these mutual funds give fund managers complete freedom to invest across large cap, mid cap and small cap stocks. And that is the beauty of flexi cap mutual funds. They are flexible. So if large caps are doing well and the market is volatile, the fund manager can prioritize stability. But if small caps or mid caps are on a growth streak, the manager can tap into those opportunities and allocate more money in those pockets. It's a dynamic approach that adjusts to market conditions. Let's quickly look at the biggest flexi cap funds in India. Parag Parikh Flexi Cap manages 78,000 crores. But here if you look at the small cap holding, it's only 5.5%, because remember, fund managers can decide to allocate whatever money they want across these categories. Even for the second and third largest flexi cap fund in India, the small cap allocation, if you notice, is very low at 5.4 and 12.99%. So let's sort now as per the highest small cap holding that these funds have. And you will notice right away that JM Flexi Cap, Tata Flexi Cap, HSBC Flexi Cap, they have a higher small cap allocation. But here's one very interesting point to note. The average small cap allocation in a multi-cap fund was about 30%, which makes sense, right? Because 25% has to be in small caps. But if you notice in Flexi Caps, no fund except for JM and Tata Flexi Cap has more than 25% money in small caps. Majority of them have it between the 10 and 12% range. Let's look at the rolling returns for a monthly SIP for both. Here's how small caps have done, and now I'll add flexi caps to it. And you will once again see the returns are more stable, right? They move up and down lower, especially again very evident during the COVID crash. But what about long-term median rolling returns? In that case, small caps have generated 15%, flexi cap at 14.1%, but flexi caps have taken on again significantly lower risk, which is captured in the standard deviation. And the final strategy to invest in small cap mutual funds is by investing in a dedicated small cap mutual fund. And usually it is best to pair a small cap mutual fund with different kinds of funds. So let's say you could have 50% of your money going into large caps, 25% in mid caps and 25% in small caps. It is never advisable to invest all your money only in small cap mutual funds for a host of reasons. It's quite simply way too much concentrated risk in the most risky category in the Indian stock market. Here's an Excel sheet that I've prepared that, by the way, you can access through the link below the like button. In it, I'll give you an idea as to how your portfolio can be constructed and how returns and risk will be impacted if you add or remove small caps. So here's the master data. You will see the median rolling returns for an SIP for all these categories, and also the standard deviation, which measures risk. Now let's go to the portfolio working. I'll show you how to use this sheet. What you have to essentially change is column D. This is where you decide how much money you allocate to all these categories. So here I have Nifty 100, which captures large caps, Nifty small cap, which is obviously capturing small caps, and I have a large mid cap 250 index as well, where 50% of the money gets invested in India's top 100 companies, that is large caps, and the remaining 50% in all the 150 mid cap stocks. So first up, you will see that 100% allocation, if it goes to large caps, you will get a return of 13%, which is the return that large caps have generated. And here you will see how an SIP plays out. So if you have a 10,000 per month SIP, which grows at 13%, this is automatically calculating everything, by the way. All you have to do is change column D when you play around with the sheet yourself, and everything else gets auto-calculated. So now let's see how investing 50% in large caps and 50% in small cap plays out. You will see that the return has now moved to 14%, when the standard deviation has again moved higher to 3.2 because you're investing half of your money in a more volatile asset. So you now have 25.9 lakhs. Generally, again, 50-50 split between large and small caps is quite a high allocation to small caps. Let's make it more realistic, right? Let's make it say 70-30. In that case, your overall return from 13%, if you're only invested in large caps, has moved to 13.6%. And your standard deviation has gone up from about 2.08 to 2.7. So it's not jumped up by a lot as well. You can also change the number of years and see how that plays out in terms of overall long-term performance of your portfolio. Now we'll do one final calculation where, let's say you want to invest 70% of your money in large and mid-cap stocks and the remaining 30% in small cap stocks. In that case, if you notice, your returns significantly go up. They're now 15.07%, whereas your standard deviation is not as high as the small cap standard deviation. So just think about it, right? You're getting very similar returns, in fact, higher returns than small caps in this case, but your standard deviation is much lower. So this is just a sneak peek into how you can construct your portfolio. Now, one very important point to know here is that the total allocation should never cross 100% or should never be under 100%. So whatever values you're entering, just make sure the sum becomes 100% by the end of it. This was a small example as to how you can build your mutual fund portfolio. If you're looking for something more in depth, then you can pre-book my course right now at a very special price on the complete guide to mutual fund investing. The link to pre-book is below the like button, so check it out. And if you enjoyed this video, then the next one that I think you should watch is how to generate a regular income from your mutual funds through a systematic withdrawal plan. That's it for today. I'll see you in the next one.